Patience is the currency of the professional, the most undervalued yet most powerful skill in the entire domain of trading. Everyone is obsessed with the visible, the strategies, the flashing indicators, the perfect signals. Yet, long-term survival is determined not by technical knowledge, but by your ability to wait, to remain still, sharp, and emotionally uninvolved, regardless of what the charts are screaming. Most traders fail not from a lack of skill, but from a fatal biological inability to resist the urge to act when nothing needs to be done. Compelled by boredom, tormented by fear, or blinded by greed, they enter prematurely, exit too soon, and overtrade their capital until their career, their confidence, and their account are bled dry. Trading is a complete reversal of the world's reward system. In nearly every profession, action is rewarded. You are paid for hours worked, tasks completed, deals closed. Productivity is a measure of output. But the market punishes this mindset. The trader who must constantly be busy is the one who racks up the relentless losses. Here, you are not rewarded for activity. You are rewarded for waiting until the odds are overwhelmingly stacked in your favor and then executing with lethal decisiveness. The less you trade, the more patiently you filter the noise, the clearer your results become. This is a painful truth, because the human psyche craves action, detests uncertainty, and equates stillness with a loss of control. The mind whispers, "Click something. Maybe this one is the big win." That voice is not logic. It is impatience disguised as opportunity. You must understand this. Patience is not passive. This is the deadliest misconception. True patience is an active discipline. It is the conscious, intense engagement of observation, the meticulous analysis of setups, the absolute refusal to move until every single criterion aligns perfectly. The patient trader is not lazy. They are strategic. They accept that, in the messy reality of the market, doing nothing is often the single most profitable decision available. Markets spend the vast majority of their time ranging, consolidating, and churning in messy, unclear price action. Trends and high-probability setups are rare gems. If you try to force trades into every small movement, you are simply playing in the mud, where commissions and slippage chew away at your edge. By waiting, you enter with conviction, betting on the clear signal, not the distracting noise. Capital, for the professional, is not a gambling chip. It is a weapon. Wasting it on tiny, meaningless fluctuations weakens your ability to strike with force when the real opportunity appears. The greatest challenge to this patient stance is the illusion of missed opportunity. A sharp market move is seen, and the trader feels the sting of regret. I should have taken that. This is the root of FOMO, the irrational fear of missing out, and it is a direct assault on discipline. But there is no such thing as a missed opportunity in trading. There are only trades that were not part of your plan. If a move was not your setup, then missing it is not a loss. It is a victory of restraint. The disciplined trader knows that another clean, high-quality setup is always, inevitably, coming. The market is infinite. Your capital is not. Think of the legendary figures. Warren Buffett's famous principle, "The stock market is a device for transferring money from the impatient to the patient," is not just about buying and holding. It is about the ability to sit on cash for years, ignoring hype, resisting pressure, and waiting for the fat pitch. The rare, highly favorable moment where the odds are crushingly in your favor. On a practical level, consider the professional day trader who spends an entire morning watching the charts without placing a single trade. To the untrained eye, this looks like idleness. In reality, they are conserving every joule of emotional energy and financial capital by rejecting mediocrity. The amateur has taken 5 impulsive trades, exhausted their focus, and dug a psychological hole that now demands emotional rather than strategic trading. Patience is the ultimate defense against the most dangerous psychological trap: revenge trading. When a loss occurs, the primal instinct is to jump back in immediately, to win it back, to erase the sting. This is the spiral that compounds losses into disaster. The patient trader accepts the loss as the calculated cost of business. They step back. They wait until a new, completely valid setup emerges. By imposing this intentional stillness, they break the emotional cycle and prevent a small cut from becoming a fatal hemorrhage. Patience, in this way, is not just about waiting for good trades. It is about waiting out your own toxic emotions. What most fail to grasp is that patience compounds profits over time. By filtering out the low-quality trades, you naturally reduce your losses. By waiting for the highest probability setups, you boost your average win rate. By conserving your capital, you ensure you have the financial staying power to capitalize when the rare, decisive opportunities appear. Impatient traders burn through their ammunition on tiny skirmishes before the real battle even begins. Patience ensures you always have bullets left for the moment that truly moves the needle. But this mastery is not easy. It demands that you actively override biological impulse, sitting with discomfort when every fiber of your being screams for action. It is a muscle that must be built through daily restraint, practiced until it becomes second nature. A rare self-mastery few are willing to endure. The irony is that traders spend years chasing the perfect indicator or the secret system, when the real solution is internal. They don't need a new tool. They need patience. They need the ability to sit calmly while the market does nothing, and to act only when the odds align. This shift transforms trading from a chaotic gamble into a structured, reliable business. Patience doesn't guarantee a win, but it guarantees that the trades you take are the ones worth risking money on. It ensures you are not bleeding capital on random noise, but strategically applying your power where probability makes sense. The profound truth: waiting is not weakness, it is power. Every unnecessary trade you reject strengthens your discipline and increases your probability of long-term survival. The hidden cost of activity: impatience as the silent killer. The most profitable action in trading can sometimes be no action at all. Many mistakenly believe success requires constant activity, the ceaseless clicking of the mouse. But this is the opposite of the truth. Impatience is the greatest hidden cost in trading, slowly and silently bleeding accounts dry without the trader even realizing the wound. Every rushed entry, every forced position, every trade taken simply to feel engaged, carries a price far higher than the commission. Impatience disguises itself as productivity. The trader believes they are working hard by constantly scanning charts and entering trades frequently. But they are merely feeding an urge for motion, confusing busyness with discipline. The market rewards precision, not movement. The impatient trader may take 24 low-quality trades in a week and end in a deficit. The patient trader takes 3 high-quality trades and ends in profit. The difference is not skill or intelligence. It is discipline to wait. One primary cost of impatience is entering too early. The trader spots a potential setup but lacks the restraint to wait for confirmation. They chase the price, afraid of missing the move, only to jump in mid-candle just before the inevitable, painful pullback traps them. The trade's logic was correct, but their impatience turned a valid system into a loss. Another cost is overtrading, entering positions for no reason other than boredom. Sitting in front of a flat chart becomes unbearable. The brain seeks stimulation, so the trader invents a reason to click, simply to feel engaged. These boredom-driven entries are almost always low probability and relentlessly erode the account. Impatience also triggers emotional exhaustion. Each rushed trade exposes the trader to unnecessary stress. They panic, close early, watch the market move in the right direction, re-enter, get stopped out, and spiral into frustration. This cycle drains mental energy, leading to fatigue that makes disciplined execution impossible. The mental fatigue creates a vicious loop. Impatience fuels mistakes, and mistakes fuel more impatience. Financially, this adds up powerfully. If a patient trader exposes $250 in a week on 5 high-probability setups, an impatient trader might expose 4 times that amount on 20 low-quality gambles. The low-quality losses inevitably outweigh the sporadic wins. The psychological cost is equally devastating. Impatience breeds self-doubt. Every bad trade makes the trader question their system, their ability, and their future. This self-doubt is corrosive. They may abandon a perfectly sound strategy because they never gave it the necessary time to play out, always chasing the next shortcut. This constant system hopping is a symptom of impatience, not a flaw in the strategy itself. Furthermore, the impatient mind is blinded to the bigger picture. It treats each trade as a must-win event, creating a short-term pressure that sabotages long-term success. The market will always present another opportunity tomorrow. Patience protects the capital and the clarity needed to seize it. The irony is that boredom is a signal of control. It means you are not finding a valid signal, and you are doing the hard, disciplined work of waiting. The impatient mind fears the silence. The professional embraces it. Patience is not passive. It is active discipline. It is the deliberate, conscious choice to resist the urge to chase and to trust that the market is infinite. But your capital is finite. The market pays the patient, not because patience is kind, but because patience protects you from the losses that rushing guarantees. It is the invisible force that keeps you alive long enough to thrive. The trap of forcing trades. When action is self-betrayal. The hardest truth for a trader to accept is that the market operates entirely on its own schedule. It does not care about your financial goals, your daily target, or your determined mindset. It will present opportunities only when it decides to. The inability to reconcile one's own urgent needs with the market's complete indifference is where most traders fail, falling into the lethal trap of forcing trades. Forcing trades is the antithesis of patience. It is when you look at a chart, know deep down that the setup is not clean, but convince yourself to enter anyway, telling yourself, "It looks good enough," or bending your rules just slightly. Every forced trade is a fracture in your foundation. One may not destroy you, but the repeated fractures collapse the entire structure. When you force a trade, you cease to be a trader. You become a gambler, and the market is expertly designed to punish gambling. The trap is sprung when you've been sitting for hours, and the pressure builds. Boredom, the desire to feel productive, or the stress of a target deadline compels you to click. You enter, and almost instantly, the market confirms your internal self-doubt by stopping you out. This is a devastating psychological loss layered onto the financial one. Every time you take a trade you shouldn't, you erode self-trust. You stop believing in your rules because you have proven to yourself that you don't follow them. This lack of conviction leads to hesitation on the right setups, making you sloppy and inconsistent. The cycle accelerates quickly. One unnecessary loss fuels the temptation to take a second, weaker trade to win back the money. You begin to chase, reacting emotionally to the market instead of executing your plan. The deeper you sink, the harder it is to stop. Traders blow entire accounts, not from one bad trade, but from the chain reaction that the initial forced entry unleashes. The core reason for this self-betrayal lies in psychology. Our brains hate uncertainty and crave instant gratification. The modern world feeds this wiring, but the market demands the opposite. Slow, patient endurance without knowing when the reward will arrive. The irony of the forced trade is that it provides the illusion of control while actually destroying it. When you follow your plan, even a losing trade is a disciplined action. When you force a trade, you are out of control, even if it wins. A winning, forced trade is often the most dangerous outcome, as it rewards bad behavior and validates the bending of rules. This leads to the inevitable, a massive loss that wipes out all the accumulated small, disciplined gains. The collapse was not caused by the final loss. It was caused by the slow, compounding habit of forced entries. To escape this trap, you must radically redefine success. Stop measuring success by daily profit. Instead, measure it by daily discipline. Did you wait for your setup? Did you preserve your capital? If the answer is yes, you succeeded, even if you took 0 trades. View not trading as active work, not wasted time. The hours you spend waiting are non-negotiable. They are spent protecting your capital and building the patience that separates the professional from the amateur. The trap of forcing trades is intrinsically linked to the fear of missing out. You must internalize this truth. You do not lose money by missing a move. You only lose money when you click. The market will always create another opportunity. Patience protects the capital and clarity needed to seize it when it arrives. You don't have to catch every move. You don't have to trade every day. You just have to protect your account and wait for the obvious trades, the ones that align with your plan, the ones that require zero convincing. Patience, the ultimate edge and the art of stillness. Patience is the ultimate universally accessible edge. It is what separates those who survive and thrive from those who vanish. The irony is that it is free, yet almost no one uses it. Patience feels invisible because it leaves no external evidence. You can't post a screenshot of 3 weeks of disciplined silence. But behind that silence is an immense power, the avoidance of dozens of losing trades, emotional mistakes, and fatal traps. The market did not defeat the failed trader. Their own impatience did. Patience is the shield against greed. Greed whispers that you must always be doing more, catching every move. Patience answers with strength. I don't need every move. I only need my move. This distinction alone is enough to save an account from destruction. Furthermore, patience is required to see a system through. Many traders abandon good systems prematurely, expecting instant results. They dig up the seed every 2 days to check for growth. You must plant your system and give it the time to grow. That is patience in its purest form. The market itself directly rewards patience. Most price action is noise, random fluctuation. But the moments of clear trend, the powerful, decisive moves where money is truly made, are rare gems. They do not happen every hour. If you cannot wait, you will never catch them. If you wait, you will be ready when they come. This resilience also changes how you experience loss. Without patience, every loss feels like a personal failure, triggering the impulse to revenge trade. With patience, losses are seen as the necessary cost of business. You wait because you know the market will always give you another chance, granting you the perspective to prevent a small cut from becoming a fatal wound. The core lesson of the greatest traders, from Buffett to Livermore, is the same. The big money is not in the buying or the selling. It is in the waiting. Patience is the invisible discipline that prevents you from blowing up, the silent filter that keeps you focused on quality, and the quiet strength that separates signal from noise. It is not something you master once. It is something you must practice every single day. When you inevitably slip and click impulsively, you return to the practice. Patience is not about perfection. It is about persistence. The final question is not whether you can find a winning strategy. It is whether you can master the waiting game, the hardest game of all. When the market goes silent, when boredom and fear whisper in your ear, will you wait? The irony is that boredom is a signal of control. It means you are not finding a valid signal, and you are doing the hard, disciplined work of waiting. The impatient mind fears the silence. The professional embraces it. Patience is not passive. It is active discipline. It is the deliberate, conscious choice to resist the urge to chase and to trust that the market is infinite, but your